So thank you very much to all of you for joining. I think without further ado, what I'd like to do is first of all introduce myself. My name is Robin Thornton. I'm the host for today. I'm a financial planner. I work for Holborn Assets. And without further ado, I would like to introduce our presenter today, which is Mr. Andrew Southgate, who is a chartered financial planner, again, obviously with Holborn Assets. And he's going to run you through some slides. So Andrew, over to yourself.
Thanks very much for the introduction there, Robin. As Robin stated, yeah, my name is Andy Southgate and I work for Holborn Assets. I'm one of the senior partners here in the Iberian Peninsula. Just a quick explanation before we kick off. I am actually in the middle of suffering from COVID, so if I do sound a little bit nasal or gruff or whatever, or look a bit under the weather, that's because I am a man that's currently in the middle of a bout of COVID. So I hope that doesn't distract or detract from the presentation in any way. Anyway, so first, a little bit about the company. Look, as Robin explained, we are an international firm of financial planners and tax planners as well. We've got offices all over the world, as you'll see on the screen at the moment. So we're in the EU, the UK. We also have an office in the USA, which isn't on the screen, in Asia, the Middle East, and so on. We've got around 250 people that work for us as advisors around the world, plus all of the support staff as well. And we look after around about $2 billion in US dollars worth of assets. Okay, so that's a bit about the company. So look, what is it that we actually help our clients with in Spain specifically? Well, some of those are on the screen now, but essentially what we do is we give them a financial plan, a financial roadmap to help our clients to reduce tax, help with Spanish reporting requirements, and give them peace of mind. So it isn't exhaustive in any way what's on the screen at the moment. And really, it's just a taster of what we do. So please feel free to contact us for a one-to-one discussion about any of the issues I'm going to raise during the presentation. And that's because we would want to tailor any conversations that we have to your specific circumstances and objectives. So one of the most effective ways to reduce your tax burden in Spain is to use a Spanish compliant account. So I'm going to run you through an example now of how you're able to actually save money on that. So imagine you've made an investment of €500,000, but with no tax efficiency around it at all. So it's not in any type of particular account. You've made a gain of 10%, and you decide that you'd like to realize that gain and take out the 10%, the €50,000. So the way that tax in Spain would work on that is that the first €6,000 would be taxed at 19%. The subsequent €44,000 would be taxed at 21%, giving you a total tax bill of €10,380. However, if you'd done exactly the same thing but invested the money into a Spanish compliant account, only 10% of that gain would have actually been taxed. So that is €5,000, obviously. So €5,000 tax at 19% would give you a total tax bill of €950. So, you know, this is a complete no-brainer. You've just made a tax saving of €9,430 on that particular gain. So that's a really simple, really straightforward way to actually reduce the amount of tax you pay on any savings and investments that you may have. Okay, so I'll move on to something a little bit more complicated and a little bit less understood in Spain, and that's wealth tax. So start by saying that Spain, as you may know, has 17 autonomous regions, and they're all able to vary the rates of tax that they charge. So it makes Spain a very complicated country from a taxation point of view. Now, Andalusia, for example, has a wealth tax, as does Catalonia, as does Murcia, as do the Balearic Islands, and various others. By contrast, Madrid does not have a wealth tax. So if you live in Madrid, you'll never pay any wealth tax, at least as it stands today. So depending on where you live or where you're thinking of moving to, you know, this could or may not be an issue. but I'll cover off some of the main points. So the allowances are €1 million per person for Spanish residents, and that's split into two parts. So you would be given a €300,000 allowance on your property or your main residence. It has to be your main residence, and a subsequent €700,000 allowance on any other assets. Very important to remember at this point, this is on your worldwide assets. This is not just about assets that you hold or that you own in Spain. It's anywhere in the world, okay, if you're a Spanish resident. In Andalusia, the rates are progressive. I'm using the Andalusian figures here today, and they can go as high as 2.5% on wealth remaining after you've used your allowances. Other areas, for example, the Balearics and Valencia, have higher rates than that. Again, they can go above 3%. So it does depend on where you're residing. There are various exemptions in place though, so I've put a couple of them up on the screen. It's not exhaustive, but there's a few up there. So antiques and works of art, for example, and also a really big one, pensions are completely exempt, but only if they're in the European Union. So any people here that are from the UK or in the UK, particularly, we've had Brexit now, we're outside the European Union. If you're in the UK and any other third country, so non-EU country, your pensions can and will attract wealth tax, especially for non-government pensions anyway. So please do come and talk to us if you feel you've got issues around this particular area. So on the next slide that I'll move on to, I'll cover off how you can potentially reduce or even eliminate wealth tax entirely. So the first thing that you could do would be to restructure assets into joint names to utilize the allowances available. So in other words, you can put property or savings, investments, and so on into joint names with a spouse or civil partner or something like that. You could also look at doing a type of pension known as a QNUP, which stands for Qualifying Non-UK Pension Scheme. Now, any money or assets that you were able to or willing to invest into this type of scheme may be completely outside the scope of wealth tax. Now, I use the phrase maybe because tax advice would be required here. It's very important that you seek specialist and professional tax advice in this area if you are considering this, and that would need to be submitted at the time that you were looking to place the money inside this type of scheme. I won't say any more on this particular presentation today because this is a really complicated area of planning. It can and does work for many people, but you would really need to talk about the specifics of your situation before going into further detail. Another thing you can do, as I alluded to on the previous slide, is that you could transfer non-EU pensions to the EU. For example, there's something called a QROPS you can use to move UK pensions into, which works really well to get you outside get your pension outside the wealth tax net, as it were. Another thing you could do would be to use liabilities. In other words, something like a mortgage, any kind of debt really, to reduce your overall net wealth. And here's the real major issue with wealth tax. One thing you can do that really could lower your wealth tax bill significantly would be to reduce your level of taxable income to benefit from something called the 60% rule. Now, there is a rule in Spain with wealth tax that most people don't really understand or know about. And what that means is that the overall amount you pay cannot exceed 60% of your gross taxable income. Therefore, if you are resident in Spain, it's worth exploring your options as to how you can lower this taxable income to benefit from the 60% rule. Now, it's beyond the scope of what I'm going to talk about today to go into huge detail about the rule. However, the main point here that I'm trying to get across is that wealth tax can be manipulated downwards legitimately by restructuring the way you receive your income in Spain. I won't say any more on here, but feel free to ask questions if you have any or get in touch with us. Another way is you can gift assets, gift money, gift property or whatever else to your spouse or kids or whatever, and that will obviously reduce your net wealth too. And a Spanish compliant account that I talked about earlier on in the presentation, that is one way, especially if you make withdrawals from it, to legitimately reduce your taxable income in Spain and therefore reduce your wealth tax liability. So again, please do talk to us about that. So look, we've only been through 4 or 5 slides. This wasn't intended to be a long presentation. It isn't, as Robin mentioned at the outset. So in summary, we've been through some brief and hopefully some useful ways that you can reduce your tax burden in Spain. And hopefully we've given you a flavour of what is possible. But really, the whole point of this is to open up some conversations, and hopefully we've got some good questions coming in, and we'll endeavour to answer those now. So thank you very much, everybody.
Yeah, Andy, thank you very much for that. I've got 3 or 4 questions here, and also some that have come in, like I say, through other media channels, the people that couldn't make today. So first question really is, what is a Spanish compliant account? What makes it compliant?
What makes it compliant is the actual policy conditions set out by the provider of the account. So in practice, what happens is that Spanish compliant accounts are provided by life insurance companies. And life insurance companies will typically go to the Spanish tax authorities, obtain the relevant licenses, and then say, okay, here's our policy conditions. Do they meet with Spanish tax law and qualify, to become a Spanish tax compliant account? And if they do, they will be issued with what's called a DGS reference, which is simply just a rubber stamp, if you like, from the Spanish tax authority saying, yeah, we recognize this as being compliant. It's all in compliance with the relevant rules and laws of Spain. And you can go ahead and market that type of account within our country.
That's great. Thank you for that. Another question that came in earlier today revolves around wealth tax. Obviously, you put a very useful slide on the screen there. Wealth tax is a one-off, or is it an annual charge?
A wealth tax would be an annual charge. It would be calculated as of the 31st of December in any given tax year, and your return would have to be in the same time as the Spanish tax return, which would be by the end of June the following year.
So, for example, if a typical client of ours had a couple of properties in the UK, now lives in Spain, those properties have obviously gone up substantially in value, that would be triggering an annual wealth tax, or potentially,
yeah, if it's above the allowances to trigger, yeah. Okay,
great, thank you. Christopher Coles has just asked a question online, just talking about Spanish compliant accounts. It's a little bit detailed, Chris, if I can say, and perhaps we could explain in a bit more detail personally. But the way that Spanish compliant accounts work is that they are effectively only taxing the gain. So they see the initial capital as being, should I say, the gain, how can I explain this simply? The gain is the bit that's taxed. The rest of the withdrawal is seen as a return of capital, which is not taxed, and that's why it reduces it right down. And yes, we do manage these types of products. They are actually all over the globe for different jurisdictions. So there is, for example, a similar set of products available in Portugal and France, and in the UK as well. In the UK, there would be a collective called a collective bond. And yes, we do manage, and that's our bag, so to speak.
Yeah, I mean, just important to mention that whilst we do manage the account itself, the underlying investment that you would make into the account would typically be managed by an outsourced investment manager, not Robin or I, for example, just to make that point.
Yeah, we're not sat here trading and dealing and doing things like that. We're planning.
And I think, Chris, you've mentioned in the chat here, is there a holding period during which I'm unable to access the initial investment? No, there isn't. Some of the accounts have penalties for withdrawing the whole amount of the investment within the first 5 years. Typically, you're allowed to withdraw around 85 or 90% of the initial investment within the first 5 years without any kind of penalty.
Yeah.
So you do have access from day one.
Okay. And I think that's it really in terms of questions. That's good from me. I've covered off the ones that that have come in previously as well. So Andy, thanks for that. If there is nothing else or any other questions from any of the people online, I'll just give you a moment or two to put anything in the chat box. Other than that, the presentation will be available on the website. Please reach out to either myself or Andy to have any personalized advice, as Andy said to start with. It's really important you get good quality advice, and that's what we're in the business of providing. Andy, anything from yourself?
That's great. Thank you, Robin, and thanks for your time, and thanks for inviting me.
All right. Have a great day. Thank you all. Take care.
Cheers. Bye.
Bye-bye.